The Master of the Cycle, Lessons from the Life and Times of Howard Marks. Well, good morning. It is a pleasure to be with you all once again. We have explored many different paths to success in the markets, from the stock pickers to the global speculators, from the architects of compounding to the systematizers of value. Today we turn to a man whose wisdom lies not in predicting the future, but in understanding our position in the present. He is a philosopher of the market's rhythm, a master of risk, and a profound thinker on the very nature of investing itself. He is less concerned with the destination of any single asset, and more with the topography of the entire landscape, teaching us to read the emotional weather of the market with the skill of a seasoned sailor reading the sea and the sky. His name is Howard Marks, and for decades his memos to investors have been required reading for anyone seeking to navigate the cycles of boom and bust. His story is not one of a single spectacular trade, but of the consistent, disciplined application of a powerful framework for thinking. He teaches us that while we cannot know what will happen, we can often know where we stand, and that self-awareness of our position in the cycle is the greatest advantage of all. In a world obsessed with forecasting, he offers the profound power of orientation. Act 1. The Education of a Disciplined Mind. Howard Marks did not set out to become a Wall Street legend. His journey was one of gradual, deliberate accumulation of experience. He studied finance at the Wharton School, absorbing the foundational theories, and then began a career that would give him a well-rounded, practical education in the business. He worked in equity research and as a portfolio manager, learning the essential craft of company analysis, the art of dissecting balance sheets, income statements, and competitive positions. This was his first language, the language of intrinsic value, but his thinking was truly shaped. His investment DNA fundamentally altered when he moved into the less charted territory of high-yield bonds and distressed debt at Citibank in the 1970s and 80s. This was not a field for the faint of heart or the conventionally minded. It involved lending to companies that were often in financial trouble, emerging from bankruptcy, or considered too risky by traditional conservative banks. In this arena, the analysis was turned on its head. It was not first and foremost about upside potential. It was primarily about the risk of permanent loss. The first question was never how much can I make, but how much can I lose? This experience in the financial trenches forged his core, unshakable belief that the most important job of an investor is not to maximize return, but to intelligently control and manage risk. He learned that to be successful in high-yield investing, you had to be a professional skeptic. You had to cultivate a mindset that actively looked for what could go wrong, for the hidden flaw in the business model, for the covenant that could be broken, for the assumption that was too optimistic. You had to understand the downside in vivid, painful detail before you could even begin to consider the upside. This defensive, risk-obsessed orientation became the bedrock of his entire philosophy. It was here he learned that avoiding the losers is the surest path to being around long enough to find the winners. In 1995, armed with this hardened worldview, he co-founded Oaktree Capital Management with a focused mandate on these less efficient, often feared areas of the market. Oaktree would grow to manage over $100 billion, becoming a titan of alternative investing. But its success was built on a principle that seems counterintuitive to many. The primary goal is not to make the most money in the short run, but to achieve the best risk-adjusted returns over the long term. This meant sometimes underperforming in raging bull markets by refusing to participate in the excesses in order to dramatically outperform during the inevitable busts. It was a philosophy of patience, discipline, and supreme respect for the destructive power of risk. Act 2. The Power of Second-Level Thinking. Howard Marks's single greatest contribution to investment thinking, the concept that forms the intellectual engine of his entire framework, is the rigorous distinction between first-level and second-level thinking. First-level thinking is simple, superficial, and accessible to all. It is intuitive and uses straightforward, often simplistic, logic. It is the thinking of the headlines and the cocktail party conversation. A first-level thinker looks at a promising technology company and says, "This is a good company with a great product. It's going to do well, so I will buy the stock." Or, observing a recession, concludes, "The outlook for the economy is bad, and profits will fall, so I should sell my stocks." First-level thinking is fast, easy, and comforting because it aligns with the apparent consensus. The problem, Marx argues, is that because it is so easy, it cannot be the source of any sustainable advantage. If everyone is thinking on the first level, and the market price reflects that first-level consensus, then you will only ever achieve average results. Second-level thinking, by contrast, is deep, complex, strenuous, and convoluted. It is a different, more rigorous mental process altogether. It requires introspection, skepticism, and a willingness to be lonely. A second-level thinker considers the same promising technology company and embarks on a more challenging line of inquiry. It's a good company, yes, but is its quality so obvious that it is already fully appreciated and embedded in the current stock price? In fact, is the price so high that it now assumes perfection, leaving no room for disappointment? Is the sentiment so universally positive that there is no one left to buy? Could there be a subtle reason? A coming technological shift, a hidden cost, an arrogant management team that others are missing, which could cause it to underperform the rosy expectations? What is the scenario in which this good company turns out to be a terrible investment? Second-level thinking understands a fundamental truth of markets. For you to achieve a superior result, your thinking must be better than the collective thinking of the millions of other market participants. To beat the market, you must hold a view that is not only different from the crowd, but, crucially, correct. This is incredibly difficult. It requires genuine insight, and it often requires the courage to be contrarian, to stand against the prevailing wind of popular opinion. Marx eloquently states that the market will often reward you for agreeing with the consensus because the consensus is often right in the short term. But it will only reward you with average returns. To achieve superior returns over the long haul, you must be right when the consensus is wrong. And that daunting, lonely territory is the exclusive domain of the second-level thinker. Act 3, understanding the market cycle and controlling your emotions. This concept of second-level thinking leads directly to the other pillar of his philosophy, a deep, almost spiritual understanding of market cycles. Marx does not believe markets move in a random walk. He sees them as a living, breathing entity, swinging like a pendulum between the twin primal emotions of greed and fear, and between the two fundamental states of undervaluation and overvaluation. This pendulum, he cautions, rarely rests for long at the center, which is the theoretical point of fair value. It is almost always in motion, swaying toward one irrational extreme or the other. The cycle is not fueled primarily by economics, but by human psychology. When things are going well, investors move from optimism to confidence, then to exuberance, and finally to euphoria. In this state, they begin to believe that high profits are a permanent new normal, that the business cycle has been repealed, and that risk has magically disappeared. They focus only on the potential for gain, dismissing caution as an antiquated notion. This collective psychological shift drives prices far above any reasonable estimate of intrinsic value, creating a landscape of low prospective returns and high danger. Then, inevitably, something changes. A catalyst emerges, a missed earnings report, a rise in interest rates, a geopolitical event, and the psychology reverses. Optimism curdles into anxiety, anxiety into fear, and fear into panic and capitulation. Investors now see only risk and the potential for permanent loss. They sell indiscriminately, fleeing assets with no regard for their underlying value, driving prices to irrationally low levels. In this phase, the pendulum has swung to the opposite extreme of fear and despair. The key insight from Marx, the practical application of his wisdom, is that while we cannot predict the exact timing of these swings, we can, with careful observation, often diagnose our position within the cycle. We can take the market's temperature. We can know with a reasonable degree of confidence if the pendulum is hovering near an extreme of greed or an extreme of fear. And this knowledge, this situational awareness, is immensely powerful. It provides a compass in a storm. His entire approach is built on acting in a way that is consciously contrary to the emotional state of the market. When others are euphoric, when the financial news is universally positive, when taxi drivers are offering stock tips, and the pendulum is swung far toward greed, the second-level thinker becomes cautious, even defensive. He sells assets that have become overpriced, raises cash to build dry powder, and rigorously avoids the most popular and frothy investments. He knows with certainty that high prices mathematically imply low future returns and high risk. He is not trying to catch the very top. He is simply getting off the dance floor while the music is still playing. Conversely, when others are panicked, when headlines are screaming catastrophe, when assets are being liquidated indiscriminately, and the pendulum is swung far toward fear, the second-level thinker musters his courage and becomes aggressive. This is the time he has been waiting for. This is when he wants to buy, when his carefully husbanded cash becomes a strategic weapon. He knows that low prices imply high future returns and low risk. He famously says, the absolute best buying opportunities come when asset holders are forced to sell. In times of crisis, when others are paralyzed by fear, he is not afraid. He is prepared, decisive, and active. He understands that the time for comfort is when others are comfortable, and the time for discomfort, for courageous action, is precisely when everyone else is most uncomfortable. The timeless lessons for us. So what can we, as investors striving for success and sanity, take from the profound wisdom of Howard Marks? His memos provide a veritable guidebook for rational investing. 1. Think in terms of probabilities, not certainties. The future is not a single, predetermined event, but a range of potential outcomes, each with its own likelihood. Our job is not to be a prophet, but to be a thoughtful odds maker. We must assess the probabilities of various scenarios and invest only when the potential rewards adequately compensate us for the risk we are taking, and when the probability of a positive outcome is significantly higher than that of a loss. This probabilistic thinking is the very essence of what it means to find a margin of safety. 2. Be contrarian, but be smart and reasoned about it. It is not enough, and in fact it is often disastrous, to simply do the opposite of the crowd. Contrarianism for its own sake is just another form of folly. True contrarianism must be the result of a well-reasoned second-level thought process. You must be able to articulate why the crowd is wrong, where their first-level thinking is flawed, and what the market is mispricing as a result. Being a contrarian without insight is not being clever. It is just being stubborn and wrong. 3. The relationship between price and value is everything. This is the golden rule that must be etched into every investor's mind. Even the world's best, most pristine asset becomes a bad investment if you pay too high a price for it. Conversely, a mediocre or even a flawed asset could be a spectacular investment if you can buy it at a low enough price, a price that provides a vast margin of safety against its imperfections. The quality of an asset cannot be judged in a vacuum. It can only be judged in relation to the price you pay. Always know which you are getting, a great company at a fair price or a fair company at a great price. 4. Control your own psychology. The goal is to survive. The most catastrophic losses occur not during bull markets, but when investors are forced to sell during bear markets due to psychological or financial pressure. Therefore, the number one goal in a declining market is to ensure your own survival. This has two components. First, a financial component. Avoid excessive leverage that could trigger margin calls, and always maintain adequate liquidity so you are never a forced seller. Second, and more difficult, is the temperamental component. You must cultivate a psychology that allows you to hold on to your valuable assets or even to buy more when everyone else is selling in a blind panic. This requires an almost preternatural calm and a deep-seated faith in your own process. 5. Embrace the liberating idea of "I don't know." In a profession filled with overconfident prognosticators, the greatest investors are defined not by what they know, but by how they handle the vast universe of what they do not know. Having the intellectual humility to admit the limits of your knowledge is a supreme strength. It will keep you from venturing into areas you don't understand, from taking risks based on unfounded predictions, and from being swayed by the false certainty of gurus. Embracing uncertainty forces you to focus on what you can know: the present price, the historical cycle, the general range of probabilities, and to build a robust strategy around that, rather than a fragile one based on a specific prediction. Conclusion: a framework for all seasons. In the end, Howard Marks's legacy is not a stock-picking system or a technical indicator. It is something far more valuable, a durable framework for rational behavior in an often irrational world. He gives us the mental tools to understand the environment, to control our own emotional responses, and to make disciplined, unemotional decisions based on the eternal relationship between price and value. He shows us with relentless clarity that consistent, long-term success does not come from making a series of brilliant predictions. It comes from the more humble, yet more achievable, practice of avoiding stupid mistakes, of recognizing the powerful, recurring cycles of the market, and of having the courage and the prepared mind to act with discipline when others are being ruled by the primal forces of fear or greed. It is a philosophy that emphasizes preparation over prophecy, temperament over intellect, and process over outcome. That is a lesson not just for investing, but for navigating the uncertainties of life itself. It is a lesson for the ages. Thank you.